We're very pleased to receive today Mr. David Humphrey, who was formerly the chief economist of the London-based mining company Rio Tinto and of Russia's largest mining company, Norilsk Nickel. Prior to entering the mining industry, you worked in the UK government service as an advisor on mineral policy. You also lectured and published widely on the economics of the mining industry. Mr. Humphreys, welcome.
Thank you very much.
So, as I mentioned in your bio, you published widely on the economics of the mining industry, and you recently published a book you named The Remaking of the Mining Industry.
Correct, yes.
Which tackles the phenomenon of commodities supercycle. Can you explain a little bit to our audience what is a commodities supercycle first?
Well, so far as I'm aware, there's only ever really been one major commodity supercycle, certainly in my lifetime. But the thinking behind the supercycle was that the industrialization of the emerging world, but more specifically the industrialization of China, was going to drive a prolonged period of above average growth in the demand of the industry, and this was going to put huge pressure on mineral supplies right across the board and support prices at a high level over a very sustained period. And this was the notion of the price supercycle. Certainly we had a cycle which was had a fairly acute amplitude, very high prices, and quite a prolonged period of high prices that, with a dip for the financial crisis of 2008, early part of 2009, really ran from about 2003 through to about 2012, at which point things started to slow down. So that was a fairly extended period for a price cycle. So in that respect, yeah, I mean, it was a long and strong cycle, and that's what led to this designation of a super cycle. Of course, you know, that super cycle pretty much over now. I think we can say fairly definitively is over now. But by 2014, which was the year in which I wrote most of the book, it was already clear that the cycle had run its course, and I was interested to use that opportunity to kind of look back over that rather extraordinary period in the life of the mining industry, and begin to disentangle what had happened, try and explain a little bit why it happened, and what some of the consequences of this for the longer term would be. And I concluded that although as was fairly self-evident by that point, that the prices had come full circle and had come back towards where they had been before the cycle started, that the boom had catalyzed some important changes in the mining industry, and that the industry coming out of this prolonged boom was different in certain fundamental ways from the industry which had gone into it. And this was hence the title of the book, The Remaking. I wanted to say, yes, we've been through this cycle, but the industry now is different in some important ways from the industry that entered the cycle. And I identify in the book certain differences. Possibly the most important was the shift in the customer base of the industry that took place during these years. 20 years ago, and indeed before that, in the early part of my career, most mineral demand globally came from within the developed market economies, within the OECD countries, what IMF refers to as the advanced economies. And over this last 20 years, we've seen a complete shift, turnaround in that. So we've gone from a situation where 20 years ago, something like 2/3 of mineral demand was coming from the advanced economies. Today, 2/3 to 3/4 of global mineral demand is coming from the emerging market economies. And so this partly represents a geographic shift, but it also has had other implications in how business is transacted. And I look, for example, at how the growth in a different type of customer, particularly smaller customers, more family businesses, trader-minded businesses have pushed the transactions in the industry more towards a spot market business, away from contract business. And so to take a business like iron ore, where this has been most dramatic, this was a business which for 45 years was almost solely conducted on the basis of long-term contracts. Today, all the business is conducted in relation to quotations on the spot market, and to a lesser degree, greater or lesser degree, several other commodities like coal, like copper concentrate. So the first issue that has changed as a consequence of the boom was this issue of the customer base. A second one is the players in the industry. The emerging market companies, this is on the production side, of course, the emerging market companies have become much bigger and more important players on the global stage. Companies such as Norilsk Nickel, who as you've already mentioned, that I worked for, is an example of a large mining company that came out of the former Soviet Union. There are several others that came out of places like Kazakhstan, out of Ukraine, out of Poland. Others that came from formerly sort of non-aligned countries like India, like Mexico, Peru, and so on. And of course, also some big Chinese companies that have stepped out from their domestic market into the international market, like China Minmetals, like Chinalco, like CNMC, as China's search for commodities around the world has encouraged their own mining companies to go looking for deposits, looking for opportunities to mine and supply resources back to China. And the third and last issue that I draw attention to is the increasing role of the state in the industry. The background to this obviously is a very prolonged period through the 80s and 1990s when governments were disengaging themselves from the mining industry, privatizing a lot of assets that had been nationalized during the late 60s, early 70s. As prices of commodities rose, governments started to reevaluate their role in the sector, and obviously began to take a much greater interest in the benefits that the industry could provide to their economies. So there was a kind of big shift around in government attitude towards an industry which they had become to think of as being a burden on their economies, to realize that actually managed properly, the revenues, taxation, so on, from the mining industry might actually help their own development. So we have a whole right across the industry. Government starts to re-engage with the industry from simple things like increased taxation and royalties through to arrangements that guarantee governments a stake in new projects that are set up. So And all of these things, both the change in the customer base, both the increased role of emerging market companies and the increased role of the state in the mining sector, I think are all factors which are likely to be important in the industry as we go forward. So this is a rather long answer to the question, why the remaking of the mining industry? And that it's around those particular changes that I thought I wanted to focus attention and say, yes, the cycle is over, but the world in which the mining industry operates has changed.
Thank you very much, Mr. Humphreys. And it's actually quite interesting to see what all this super cycle did to the industry. Have you had a chance, while you were researching for your books, to identify other super cycles that happened in history? If so, how did they change the industry? That's the first fold of my question. The second would be, in this remaking of the industry, were there any biggest losers, any biggest winners? If so, who are they?
Yes, I think, although we didn't call it a super cycle, clearly there was a very large commodity boom that took place back in the 1970s. I mean, there's some quite interesting parallels to be drawn in that cycle and the current one. Back in that cycle, we had the emergence of a major new industrial power, which in the 70s was Japan, as it recovered and industrialized after the Second World War and became a major consumer and major importer of commodities. We also had, in the second phase of that cycle, a period of very loose monetary policy, which curiously parallels the phase of quantitative easing that significantly drove the second phase of the more recent cycle. So there is quite an interesting parallel. What happened last time? Well, one of the things that happened last time was, then as now, governments suddenly became very interested indeed in what the industry had to offer. And it triggered a widespread nationalization in the mining industry, parallel to what was going on in oil and gas at the same time, and the assumptions were that the mining industry, could reasonably follow the example of oil and gas. And in certain parts of the world, particularly places like the Africa Copper Belt in Zambia and Zaire, as was then, would nationalize their industry. But it happened in many other places as well, like Venezuela and Indonesia. This time around, we haven't seen anything like a return to that sort of nationalization. What we have seen, I think, is a return to nationalism, to a greater emphasis on the importance of national producers. Part of the conditions which are being posed upon inward investors and in new projects in parts of the world now are a requirement that indigenous investors, not the state necessarily, but local investors, be mandated to be involved in new mining projects. So I think if one's looking in terms of winners and losers in this, the opportunity for national organizations, whether they're private investors or state organizations, has probably increased, and it's probably increased at the cost of the bigger mining companies. For no question that it's a tougher environment for the big miners. There are more players out there now, and more players with significant resources behind them, and particularly in countries which have strong domestic mining industries, the opportunities for inward investment are probably more constrained than they were previously. So it's difficult to be absolutely certain, but you know the global diversified miners were benefited from the period when the world was globalizing freely. It seems probably their model of globalization came to a halt around about 2007, 2008 when the global financial crisis hit, and some of the big mergers that were then in the pipeline, for example, between BHP Billiton and Rio Tinto, or between Vale and Estrada, all of that collapsed. And probably that was the high tide of that particular globalizing movement when big seemed to be better, and that failed. At that stage, that failed. And since then, interestingly, you've seen some of the big miners beginning to divest, beginning actually to break themselves up. Most dramatically in the case of Anglo American, which is selling off a lot of its coal, a lot of its iron ore interest, focusing down on a few core commodities. So yes, I mean the ending of the cycle, the changing of the market environment has had some important implications in terms of the structure of the industry and the players within it.
Okay. Well, do you expect any super cycle to happen soon?
No, I don't. I think it's a product of some quite special circumstances. I mean, obviously, this last super cycle, like the 70s one, was very much driven by the industrialization of Japan. This one, more recent one, was driven by the industrialization of China, which clearly far exceeded anything that we might have anticipated when we were looking at the outlook for these markets, even 15 or 20 years ago. And the degree of dominance of China is such at the moment that it remains absolutely central to what happens next. Now, I don't think that China has the capacity to give another leg up to offer us another super cycle. I think much greater risk that in the near term that its diminution of demand could actually be quite problematic for the industry. And if you're looking for another region to sort of come along and do another China, I think one struggles a bit. I mean, I've looked closely at some of the candidates for this. India obviously is one. The greater Mekong region is another area with huge growth potential. But I find it difficult to imagine that their materials intensity of growth is, or their coherence of their economic growth is going to produce a surge in demand of a scale or at a speed that we saw in China, because they're very different economies. I mean, India is a country which is built up from the bottom, from small businesses and the private consumer. China very much has kind of been driven from the top down by big programs of investment, either funded or coordinated by the government, and that is what has given their growth this extreme materials intensity, and I don't see that being replicated elsewhere. So I won't say there will never be another super cycle, but I'm not expecting one in my lifetime.
Well, how about Africa? With the emergence of Africa, do you think it can actually drive demand up to a certain level?
Look, I mean, the growth projections for Africa are clearly positive, but I mean, bear in mind, I mean, it's coming off a very low base of consumption at the moment, so it will take many years for Africa to make a meaningful contribution at a global level to minerals demand. I think much more relevant is the potential role that that Africa can play, on the supply side of the industry. I think that there were some areas that were obviously where Africa obviously performed quite well in this last cycle. Some in the mineral space. Gold, iron ore in West Africa, the revival of the copper belt in Congo and Zambia. But I don't think realistically that Africa was attracting the level of investment that it wanted, or that the scale of its resources warranted. And so, I do think that as and when, commodity prices start to pick up again, Africa needs to perhaps position itself to be better positioned to take advantage of the upturn in prices than it was last time this came along. And a lot of that, some of it's to do with obviously well-known issues like infrastructure, which always are going to be a challenge for resource development in Africa. But some of them are also to do with governance, and there are still some significant challenges of governance, particularly for inward investors in Africa, that African states could make use of the down cycle to prepare themselves for the time when the mining industry is interested to spend again. They're not that interested to spend at the moment, and frankly, investors are not going to give them the resources to spend. So, but it's an opportunity nonetheless to prepare for the recovery that inevitably will come, whether it's in 2 years, 4 years, 5 years.
Mr. Humphreys, you mentioned that sometimes in Africa it's just about some governance or other factors like that. So it would just take structural reforms and some political will to have literally a level shift of investment environment, of demand and even supply. So if that happened, that's not enough to drive the price up or the demand up for next cycle?
My perspective on this industry, shaped by my history, is very much that of the international investor, and I don't think there's any question that some African countries still represent a significant challenge, particularly for the large companies. For some of the smaller, more fleet-footed companies that have been able to operate in some of the more difficult countries, should I say, but for large companies, typically they wanting to do big projects and risk very large sums of money, have not, in many cases, felt able to make those commitments and justify them to their own shareholders. So, yes, the regime is important, but it's not just a question of what's written down, what the mining law is, what the tax rate is. It's the confidence that these will not be changed or not changed on an arbitrary and dramatic basis that will completely undermine the economic assumptions on which the investment was made in the first place. The oil industry has a concept that I'm sure you're familiar with, called the obsolescent bargain. The notion that before the investment is made, the mining company has a significant leverage relative to the government. But once the mine has been invested in, once it's been built, then obviously the power shifts to the host government, and changes that are made to the terms of that project at that stage, where the company can do very little about it, are the worst nightmare of the international investor. And so an environment of that looks good on paper is one thing, but the stability of that over a prolonged period, and also the fair implementation of the policies on a consistent basis, observing the rule of law. Clearly, these things really matter, and I mean, it's because these things really matter that countries like Canada and Australia, continue to attract a disproportionate amount of global investment in the industry, because they offer those conditions, and inward investors, have confidence that their investments will be respected. So, yeah, small changes can bring about big behavioural changes in what investors will want. But countries have to demonstrate themselves as good partners in this process, just as big companies have to demonstrate themselves as good partners in respect of their behaviours towards communities, towards the environment, and towards the good governance of their employees and their behaviours.
Mr. Humphreys, let's move away a little bit from the super cycle and the world of speculation towards more the fundamentals, and try to dive into the topic of investment decision making in the resource sector. So there are evidently many variables that go into this decision. To name a few, you have the market prices, the cost of production, the quality of the mineral. Can you, a little bit based on your experience and your book, develop a little bit this point about the variables that goes into the decision making?
Yes, I can, and I can also talk a little bit about the where it is that some of these decisions, where they go wrong. And I mean, I think there's quite a significant set of case histories now that one can use to illustrate where the big mistakes are made in investment. So typically when companies are doing investment, they will assemble a great deal of technical information about the resource, about the costs of the equipment and everything else that needs to go into that. But typically the projects go wrong on one of maybe four bases. The resource estimates sometimes can be badly off. I mean, no mining company is ever going to totally drill out a prospect. They will draw conclusions about what is in the resource under the ground before committing to it. But of course they don't know in its entirety, and it's not, I won't say it's not common, but it does from time to time turn out that the resource they thought was there turns out not to be there. There are significant cost overruns, capital cost overruns. One of the major sources of wealth destruction in the mining industry is simply getting the capital estimates wrong, or failing to deliver the project in line with the assumptions you made when you committed the project. So tight managed project control is enormously important. And then there are the more economic factors, one of which obviously is prices, possibly the single most important line that goes into a project assessment. Also one of the most difficult to assess. Certainly something I've spent a lot of time worrying about over the years as to what prices one should use for making a long-term assessment. And there are a variety of different tools one can use for this, looking at history, average prices, looking at cost curve developments, and so on. But it still represents a major risk element in any project, as does another economic variable, and this is one that I think is often overlooked, that companies can spend a lot of time worrying about prices and overlook the importance of exchange rate developments, because exchange rates can destroy a project's economics every bit as easily as a miscalculation with respect to prices. So, projects can be undermined from a variety of areas, but focusing down on those areas where in the past, they've been demonstrated to be seriously problematic, ensuring that you have the resource, ensuring that, you've thought your way around these other issues. As far as you can never be totally sure, but you do need to address the risks that each of these things brings with it. And you may still be wrong, but you need to be able to be sure when the commitment to the investment takes place that you've done all you can to identify the relevant risks, and to the extent that you can to manage those risks.
Well, Mr. Humphreys, I mean, you mentioned exchange rate, prices, and I'm thinking while looking at this, prices or exchange rates, lately there are huge fluctuations and huge variation. Yeah. So how can investors hedge against such fluctuations without actually having cost overruns? Because if you go with derivatives, those are quite costly. So how can investors actually hedge against that?
Well, there are obviously a range of different interests here. I mean, when you talk about investors, I mean, I'm assuming you're talking about the companies that are investing. Yeah, I mean, there are some devices that you can use. For example, at the point at which you commit the capital for a project, you might choose to hedge your exchange rate exposure over the period of construction. It's not going to protect your operating costs out beyond that point, but it should protect you during the high spending period of capital. Price volatility, if you're acquiring a company, then and you're going to be having to, you'll be receiving their revenues, from the day that you bought the company. Clearly, that's an issue. But if you're investing in a mine, I mean, you're probably not going to be seeing revenues out of that mine for 3 or 4 years. So today's volatility probably needn't worry you unduly, so long as your long-run price is arrived at on a realistic basis, probably a reasonably conservative basis too. If you're wise, then you can probably avoid the immediate volatility. Of course, once you're in production, there's not a whole lot you can do about it. If you're a low-cost producer, then that obviously gives you some protection against weak prices. If you are in an economy which is a commodity economy, where the exchange rate will weaken as commodity prices weaken, that again gives you some degree of natural hedge, but you'll know this when you make the investment decision, or you should have thought your way through this. Of course, if you're in the United States, you don't get this, because you're dealing with, odds are you're dealing with a US dollar project anyway, so you're not going to get any exchange rate benefit from commodity price movements, and anyway it's not a commodity economy. So, but most places in the world, many commodity economies, you do get some benefits from that. So look, there's no guarantees, but you do need to think yourself.
Absolutely, I agree. To conclude, Mr. Humphreys, you were the chief economist of a major mining company. So again, in that position, or as a chief economist of a major mining company, what would be the major world developments you'll be watching closely now?
Well, look, I mean, the immediate outlook is still dominated by China. I mean, if you look at, and much more so from the minerals than is the case with oil, for example, for the major metals, China is accounts for between sort of 45–50% of global demand, and I don't think we've seen any economy dominate these markets to that sort of degree since the 1950s in the United States. So this is a pretty unusual and vulnerable position that the industry finds itself in, and I don't think we have the answers in terms of how China is going to work its way through its reform agenda, how politically viable that research that reform agenda is. So we're pretty much focused on that, much more so for the metals than for oil, which, I mean, China is only, 12% of the world's oil demand, but 45-50% for these other things, 60 to 70% if you're looking at things like seaborne iron ore. So that has to be the number one issue. Unfortunately, it's one of the most difficult to assess as well. And thus far, demand has held up. I mean, it hasn't fallen back. It's maintained its level even as China's growth rate has slowed. But were that slowdown in China to continue to become more aggravated, then I think that would represent a real exposure. I don't think companies are really ready to make any serious investments, big investments, enter into new commitments at this stage of the cycle, so they have greater visibility on some of those big issues. And by the way, their investors are not going to allow them to do it. A lot of investors in mining companies feel a bit let down by the monies that were lost as a result of overspending during the boom years, and the write-offs that have subsequently been made to their balance sheets. So I think the mining industry has to do a certain amount of work to regain the trust of the investing community.
Mr. Humphreys, thank you very much for your very insightful comments. We hope to see you again in another episode of our discussion. Thank you very much. Thank you.